The way we look at growth is from a global perspective, which is dominated by the US growth story. So there's two things going on there. The first and most important is that, and consequently the UK is not really relevant, less than 4% of world GDP. So it is that US growth story. But the other thing is looking at the performance of the manufacturing sector compared to the service sector and consumption. So what's been keeping the US economy in particular going in the last couple of years has been the service sector, and that's still doing pretty well. It's decelerated a bit, but it's still growing. But manufacturing has had a really tough time the last 2 years globally. And that's because people have not been spending on goods, they've been spending on experiences. That's where we're beginning to see a few green shoots. It's been really grim. You know, we've seen that in Europe in particular. It's almost like the indicators, and we look at leading indicators, that's the other point. We're looking forwards rather than back. But that's getting better now.
And it feels anti-consensus, the fact that you're saying that, because everyone is turning more negative on the momentum of the US economy, and you're saying that there are green shoots to the industrial data. So that's interesting. Obviously, stock markets don't care. They don't care about the data on the ground.
Well, it's interesting this morning, the results are actually from the industrials, where
correct,
which
in
have been
Europe,
better.
so what we're seeing in Europe. But that also brings me to valuations, because in your traffic light analysis on the valuation lens, it's red, which tells you, of course, within the US, the valuations are very high, specifically for the tech sector. So what do you do in this environment? Do you buy up and chase growth, which is your green signal, or do you look for value, in which case, where is the value?
Yes, no, well, it is a mixed picture, it's fair to say. It's a bit like trying to solve a Rubik's Cube at the moment. So the red light is really, again, it's about the US, as you say. And it's mostly about the tech sector, which is so dominant. And as we know, the Magnificent Seven, just 7 stocks, 28% of the US index. Now, you can say they're great companies, but they're great share prices as well, as in high share prices. So that's what's driving that red light on valuation. But if you move outside of that sector, you move outside of the US, in fact sometimes I say the further you go from the US, the cheaper markets get. So if you go to the other side of the world, to China, actually on our valuation screener, China looks very cheap. The question is, does anyone care? And is there any catalyst there to get investors buying? But I think, and we could talk about smaller companies as well, where there's much less of a valuation problem, and the relative valuation between smaller companies and very large companies is very, very stretched. So I think there are opportunities. What we really need is growth to come through, to start to interest people in the earnings recovery, which could come through in these other sectors and sizes of companies.